Hello traders, welcome to another video. So in this video I am going to discuss about an ultimate tool for swing traders. Most of the times you might wonder stock market investing is very difficult. Yes, it is very difficult for those who complicate it. But if you keep it simple, and it is very simple, and then market actually uh, uh, gives more money or respects those who keep things simple and also disciplined and a systematic way. If you are very random and if you are not disciplined and if you make things very complicated, stock market investing becomes extremely complicated. So, in this video, I am going to bring a very simple strategy for you, which works effectively most of the times. But before that, let me tell you a regular disclaimer that I am not a SEBI registered analyst, and also this is not a buy or sell recommendation. It is only educational in content. So treat it that way, and then do your own due diligence, and then apply these strategies, and then if you find it useful, then you continue using them. So let me get into the content of that topic. So most of you must have known that 200 days moving average is a line which actually gives us what is the previous 200 days price average looks like. So for example, in this chart, so black line is a 200 days moving average. So it tells you, as soon as you plot it on the chart, it actually tells you very neatly and cleanly whenever my stock price is trading above 200 days moving average, that means my stock is in a bullish phase. If it is below 200 days moving average, that means it is in bearish phase. So every time it is above, I try to buy. Every time it is below, I avoid it. So as simple as that. So it gives one structure to your chart, and it helps you interpret where my price is now trading. It gives you a wonderful reference point, which has very meaningful reference point. And also another thing is 200 days moving average acts as a dynamic support and resistance. If you see here, price is trading here, and then it came and it took a support here and then bounced back. Again it came to 200 moving average, it took a support and bounced back. And then again it came here, but this time it did not take a support, it broke and then it went below and then tried to cross the 200 days moving average again here, but it took a resistance here and then came down, and then now it came and then it broke it and then it is trading around 200 days moving average. So if you see here, it took a support here, it took support here, it took resistance here. So 200 days moving average gives you or acts as a support and resistance, so that's very important. Then how should I convert that into a strategy, or how should I use for my entries, for my exits, for my stop loss, for my targets, so on and so forth. So that is what actually a trading system means. A trading system gives you a comprehensive and very clear entry points, very clear exit points, and also it gives you where to stop loss and where to take my profits. So how does that how does 200 days moving average help in that? So as far as the entry points are concerned, you better enter as close as possible to 200 days moving average. For example, when 200 days moving average, when the price is trading at this level, that is your good entry point. Again it took support here when it came closer, so if you enter here, that will be a very good point. Entry here is bad, entry here is bad. Why? Because it is far from 200 days moving average, far from 200 days moving average. So every time the price is going away from 200 days moving average, you have to be very careful. No entries there actually. There, these are the points where you should exit. Those are not the points of entry, but these are the points of entry, these are the points of entry. So 200 days moving average will give you a clear entry point and a clear exit point. Entry point is as close as possible to 200 moving average. Exit point is when price extends from 200 days moving average, that is where your exit point is. Now talking about other moving averages. So some people also use other moving averages like 50, 20, 10 on top of uh, 200 days moving average to plan their entries more precisely. So that will be a discussion for another thing. And then you can also combine 200 days moving average with indicators like RSI with volume, and then look at the candlestick patterns to look very closely and then very precisely, and then make an entry very precise manner. So uh, this will actually, these are additional tools like other moving averages and then other technical indicators will give you more confidence or will fine tune your entry point. When should I exit? Your exit is, for example, let's say you have taken an entry here. Your exit is, you can actually take either this trade will go and hit a stop loss or it will give you target. Both are possible. For example, let's say it's giving you a target. As far as the target is concerned, so from entry point, when the price is stretching far from 200 moving average, that will be your exit. So you can actually measure, okay, 20% is sufficient, 30% is sufficient, 40% is sufficient, and nobody can actually time it very well, and then nobody knows which is a perfect exit point. But you can actually target, and there are various target taking approaches available. But nevertheless, let's not discuss all of that into this. But when, keep it simple, that when price moves beyond or stretches far, so stretching far, let's say around beyond 20% is stretching far. So when the price goes from my entry point or from the 200 moving average more than 20%, so that is my exit point. So that's, I'm just giving you an example number. That could be 20, 40, 50, 80, 100. So there are times where stocks have actually rallied even 80%, 100%, even more also. But I'm not saying that they will not. But we have to keep some limit, and then we have to say, okay, my trading is done. Okay, so that decision you have to take it. But there are, of course, there are approaches in which you can actually decide that. But let's keep it simple. So when the price stretches beyond or stretches far, moves far from 200 days moving average, that means your exit is ready. And then you can also use other technical indicators like RSI, volume, candlestick patterns. You can observe how the chart is doing, and then how the RSI is doing, how the volumes are doing, and all those analysis you can combine, and you can precisely make an entry and exit point. Then, for example, if the stock is hitting a stop loss, then how do you decide? For example, you entered here. As soon as you enter, after some consolidation or some move, and then it did not go to target, but rather it is coming down and then crossing, let's say, coming and closing below 200 days moving average. So the moment it closes below the 200 days moving average, that's your stop loss. So you don't have to think any further. You simply close your position, because that's so critical, that 200 days moving average is so decisive that it very very clearly tells you that my stock is going to go down. For example, you see here, it closed below 200 days moving average. Look how far it had actually went. It almost 660 to 550, almost 100 points it went. 100 points means more than 15-20% drop from here. So you have to actually exit. You should not actually wait for that. So 200 days moving average will give you a very clear exit point. So you enter at 200 days moving average, you keep your stop loss below the 200 days moving average, let it run, and then see how far it is running, and then according to bullishness of the trade, bullishness of the stock, you book your profits either in a staggered manner, or keep apply any target taking systems, and then book your profits accordingly. But otherwise, 200 days moving average is a very very effective and very simple tool. If you apply it very systematically and in a disciplined manner, it will really reward you very very richly. So that's all I have for this video. If you like this video, give a like and also give a thumbs up and also share, subscribe to my channel and to my videos. Thank you.